Hey, good afternoon once again to all of our market rebels and Stu.
Yeah.
Volatility, word for the week, the last couple of weeks. Crazy markets, huh?
Hey, it's what makes it fun, John.
And that's what makes it fun. And I think we ended up about unchanged, at least on the major indexes, SPY
Yeah.
and Q. Nvidia didn't have the best day, but again, like you say, that's where the money is made. If we didn't have the volatility, there'd be no profits.
Video
But
also rallied up off at 90 on that day when it opened down.
yeah, it did make a little bit of a comeback. But it made us think about a topic that we talk about a lot. We teach our traders this. I think most of them know about it, but we think that most people have misperceptions about it. So I thought, let's do this for a topic: rolling, the myths and misperceptions. Now, before I get started, it probably sounds like we're saying, oh, they must not like rolling. To the contrary, we use it all the time. In fact, for the ICF service, our instant cash flow service, we've done it multiple times.
How many times in NVIDIA do we do?
NVIDIA, we actually did four. We had a Monday, Tuesday, Wednesday, Thursday, one
Yeah,
each day. It was moving so fast.
we rolled four times.
Yep, almost a fifth. Almost made a one for each day of the week.
Yeah.
But anyway, my point is that there's like everything else with options and strategies. There's a time for doing it. There's a time for not doing it. Rolling is a tool, and unfortunately, what most people think is they go, "Oh, well, you roll it because it's credits. You're getting paid. You're getting all this cash swept in." And that's really a big misperception, not a little one. So let's take a look at our Chalk Talk question for today.
Yeah. In a way, I'm listening to you. In a way, it is, and in a way, it's kind of not, right?
Exactly.
In a way, it's paying. You're paying a debit for a credit,
Yeah.
right? And you're getting something in return, so that's a benefit. So you got
Yep.
to pay for that.
Yep.
Um, yeah,
And
look,
we'll talk about all that.
yeah,
Yeah, they're all good. That's why we want people to think and not just do it blindly just because they think it's free money and that
no,
they
it's
have to
not.
take it.
It's not free.
So let's start off with our Chalk Talk question, which for anybody who's new is a little thought-provoking question while we're going through the presentation. And then at the end, if you still haven't figured it out, we'll go through and cover the answer. So here's our question. If you roll call options, we could also apply it to puts, but for this presentation, we're going to just focus on the call side. Will you enhance your returns? And what we mean by that is if you have two traders, let's say the stock is going up and one trader does not roll, holding maybe just a long call, the other trader rolls. Who's going to have the better outcome in terms of the total dollars? That's what we mean by enhanced returns. So think about out there for all of you out there in YouTube land, and we'll come back and answer that at the end of the presentation.
Yeah, and it's not an easy answer.
Like all of our questions on there, if you haven't figured that out already, they're never straightforward. And that's why they're not easy. And that's why people make bad decisions. So let's start off with a little bit of a review first before we get into the real heart of this presentation. And let's start with a long call. Let's say that you buy a $100 call, you spend $10 for it. Now, when you do this, one of the reasons for the appeal is you have limited losses. $10 is the most you can lose. And the other part of the appeal, you have unlimited gains. So it's not like stock. Stock, we technically have unlimited losses, at least down to zero. Certainly a lot more than $10 on a $100 strike or a $100 stock. But we still participate fully into the upside gains. So this is what our risk profile would look like. So remember, we always get a bend at the strike. So this is a $100 call. And in this example, you can see that the maximum loss over here lines up at -10. So that's the worst that could ever happen. For all stock prices below 100 at expiration, $10 is it. You can't say that if you own stock at 100. So, all right, sounds like a pretty good asset so far, but there are always trade-offs. Now, before we get into those, little quick plug for us here, marketrebellion.com/get started. If you are new to options, or even if you're not, please check us out there. We have a ton of great videos and documents, articles in there about options to help you get started. So let's take a look at risk management, Stu. This is the way that professional traders approach markets. It's never, what do you think NVIDIA is going to do tomorrow? Because if you ask Stu or me, we're going to say, I don't have a clue. I don't know.
No idea.
We could guess, but what's that going to get for you? Why not just guess coin flips? Yeah, you're going to get some of them right. It's not a way to make money.
How about this, Bill? It's either going to be up or down.
It's going to be up or down.
How's that? Is that an answer?
Right. How are you going to trade that?
Uh,
Yeah, you're just not. So what we really want to focus on is risk management. And what we're going to do, at least our first step with risk management, is to reduce the amount of money in the trade. It is not to say, oh, if the stock goes up tenfold, I'm going to make $1 bazillion. We want to focus on managing the risk. And if we can manage the risk, we can probably hold out for bigger gains. Now, one of the ways we do this with options is to roll our call options up.
Bill, can you repeat that sentence just there? If we can manage the risk, we can hold out for
or potentially bigger gains.
Everybody remember that. Remember that statement. We're going to come back to that. If you can manage the risk, you could potentially hold out for bigger gains.
You can end up making more. And that's actually the reason a lot of traders don't make it. They'll buy the call for 10, it goes up to 11, and they go, oh, I could lose 11. Let me get out and move into something else. So in the business, we say they're picking up nickels in front of bulldozers, and then it's only a matter of time before one of them hits hard. So we want to manage that risk. And even if for no other reason, by dumb luck, you will eventually hit those big home runs, provided you didn't sell out of it. And this is why it's important to manage that risk. So we do it with the call options by rolling the call options up. We roll the put options down. Same idea in the opposite direction. Again, for this video, we're just going to focus on the calls. Now, when we do rolling, whether we're rolling the calls up or the puts down, it will produce credits. And that's the main reason why people like to do it, because it gives this impression that we are just getting cash into our pockets. And as Stu said earlier, it's sort of true, you are. But what they don't realize is there's a cost for it.
You're paying for the credit.
And you're paying for that credit. And you're also, as we're going to find out, tweaking those deltas. There's a lot of things going on here that people overlook. So the main reason, or the main way that we teach people to roll calls and puts, is to sell vertical spreads. So let's take a quick review of that. Let's say we've got our $100 call here. We go into our broker's platform. We sell, let's say, the 100, 105 vertical. That means we are selling the 100. We're buying the 105. Now, we could place these as two separate trades, but that credit there doesn't stay as stable. It's what we call execution risk of having adverse stock price movement. So we like to do it as a package deal. Mm-hmm. So when we put this trade in here, what do we call this guy right here, Stu?
Looks like the sale of a vertical spread.
That is a short vertical spread. So you would just go into your broker's platform, sell the 100, 105 vertical. And when you do, take a look at this. Those two cancel. And what are you left with?
There you go.
Just a long call. If the stock continues higher, we could sell the 105, 110. That would cancel the 105 and leave us long the 110. And so on. We just keep walking along, producing these nice credits.
As the stock is moving higher.
Moving in our favor. For puts, if it's moving lower. Right. All right. So that's kind of the how. What about when? Well, this is a little bit where the art side comes in. But for longer term traders, as a general rule, emphasize general, when you can receive 80% of the difference in strikes, that's a pretty good benchmark. So let's say that you sell the 100, 105 vertical spread that we just looked at. Notice there is a $5 difference in those strikes. We take 80% of that difference, or 80% of 5, and we get $4. So now it becomes easy. You look at your broker's platform and you say, what's the 100, 105 vertical spread trading for? Well, it's trading for $3. It's not ready to roll. We look at it later. It's trading for $3.50. Getting closer, still not ready. And then it's trading for 4, maybe more, 410, 420. We say, all right, now it's time to roll. Now, what else could we do, Stu, here to make sure that we catch this in the event that it does trade at 4 and maybe we're not watching it?
We can have an order out there, Bill.
Put the order out there. We tell people sell the 100, 105 GTC. Yeah, it might be trading at 3 now, but put in a GTC order for $4, good till canceled.
Just leave it out there.
That way you're up high in the queue. You're going to be the first orders to get picked off, and that way you don't even have to watch it. It'll just take care of itself.
As an older gentleman trader who, when I first came to the floor, once said to me, and I had no idea what he was talking about, but once I figured it out, it made perfect sense. He said, "Put it out there, hope you sell it, and hope you get run over."
Exactly. Yeah,
That,
people say, but what if it goes up higher? Well, what if it does?
yeah, well, you do it again.
You then exactly right. We'll do a second roll.
More money. Why is that a bad thing?
Correct. So here's the main misperception. Now, again, most people look at this and say, well, why would you wait for a $4 credit when you could do it for 50 cents? Money's money. You might as well continue to pick up this money. Well, the main misperception is that, yes, you are receiving credits, no argument.
Mm-hmm.
But you are also synthetically paying debits. How does that happen, Stu? How can we receive credits but also be paying debits?
I think the market makers are ripping you off.
I think it is the easy one to blame, right? We'll just blame the market makers.
Yeah.
So let's go back to our $100 call.
Oh my God.
And let's say that we have sold the 100-105 vertical spread for a credit of 4. What have we done to our risk graph? Well, we've gone from the curve in black to this in blue. Notice how our bend has changed from 100 to 105. Remember in that slide where I showed the 200s canceled out and you were just long the 105? That's what's happening here. We're just long the 105 call. Now, the main reason for doing this is not because we got $4 credit and it's just money falling from the skies. It was to shift this maximum loss up by $4. I used to be able to lose 10. That was my maximum loss. Now I can only lose 6. Notice how that blue line lines up at -6. And that's because we took in $4.
Now, don't get confused with what Bill said. He said, shift up the maximum loss. He doesn't mean make the maximum loss bigger. He means shift the line.
Higher up on the right. We're shifting higher onto the graph. We're reducing the overall loss. Correct.
Right. It's already a negative. We're shifting it up to make it less of a negative.
Exactly right. Now, where's the cost though? Notice how the black line, if you kind of trace a line moving left to right, notice how we bump into the black line first and then the blue. And this horizontal line right here is where we break even. That's the 0 on our risk graph. So you can see that we have shifted that blue line out forward by $1. And notice that these two numbers right here, 4 and 1, add up to 5, which is the difference in strikes.
Yeah, that's not a coincidence.
That is not a coincidence. As we're going to find out. We're going to see a lot more of that throughout this presentation. So what if we roll from the 105 to the 110? Same idea. And actually, I forgot to put this in here. We can see this another way by looking at the break evens. When we bought the $100 strike for 10, at expiration, we'd break even at 110. When we have an effective cost basis of 6, remember we spent 10, we collected 4, we have an effective cost of 6 on the 105s. And 105 plus 6 is right there at that blue, 111. Notice there is a $1 difference there. And so that's always going to be true. As Stu said, this is not a coincidence. So if we roll to the 110, shift it out a little bit further. We roll to the 115. Now, in this case, this is kind of the ultimate goal of rolling. We'd love to get our risk graph above 0. So now in this case, we have the proverbial house money where we kind of a negative cost basis. We've collected our entire 10, but we've also got an extra 2 in our pocket. So worst case is we make 20%, but we still have this unlimited upside. But where is the cost here? Right there. And that's the part that people don't see. They see this part, but they don't see this part. And that is a real cost. Now, the other thing is that when you roll, you are going from an option that is relatively deeper in the money to one that is less deep in the money, right? If you own the 100 call and the stock is moving up and you roll to the 105, the 105 strike is closer to the stock no matter where that stock is compared to the 100. The 100 will have higher deltas. So when you roll up in strikes, every incremental dollar beyond that, you're not making as much. So in some ways, it's a double whammy. You're paying for the synthetic debit over here, but you're also reducing your deltas.
So,
Again, that's not saying it's bad. It's just a trade-off.
Bill, go ahead and ask me, is that okay that I'm not making as much?
It's exactly right. Is that okay to not make as much?
Absolutely.
Absolutely. That's part of risk management.
Because what am I getting in return? I'm getting the opportunity to, at the end of the day, have less money in it, like I was doing on the graphs here, to really have a higher strike. I mean,
And
you
to,
know,
and to potentially stay in longer because you have less fear.
remember when I said, remember that statement? See,
Yeah.
your psychological thing is like, hey, I bought them. The stock was 100, and I bought the 90s, and they went to 10, they went to 20, they went to 30, they went to 40. This is as the stock is all going up. It's like, well,
Right.
I got a 50% gain. I got this, some dumb metric. It's like, what are you going to do? When are you going to sell it? Well,
Hang on.
this helps you to not sell it because now you've
Right.
taken money out of the equation. You have a higher strike price, and it allows you the sleep at night ability to just kind of stay in it
Yep.
and then potentially make the money from over 6 months, maybe a year, 2 years,
Right.
3 years, I don't know,
Right.
from 110 to 210 or 220. Whereas
Sure.
otherwise you may not, if you really recognize what the risk was and the original option that you owned and never did anything, there's no way you're going to stay in it. You're just going to dump it and take I made 30% and be gone and be done with
Be
it.
gone.
And
Right.
then a year later, you'll look back and you'll say, oh, what a dummy I was.
And right, that this one was working. Why get out of something that's working? Manage the risk. So now to show why you're tweaking your deltas, let's look at shares of stock here in black. And we have our delta one, right? Straight line. But look at this in red. That's the $100 call. And it has curvature to it. So notice if the stock is down here at 100, if we look at kind of this little segment right in here, there's a certain angle right there. That might be our slope, or in options trading terms, our delta, which will be roughly 50. So even though the stock trader has 100 shares, the options trader is behaving like 50. And a lot of times traders will look at this and say, well, I've got unlimited upside. And that's true. But look at the angles. Look at the deltas. If you look at the angle of that black line, it is much steeper. And if that's hard to see, just extend a line off of each of those. You can see that that blue arrow is pointing much higher. So when you roll and you start going to lower and lower deltas, that's another really big cost. And again, that doesn't make it wrong, but you have to realize when and how to roll and why. Sometimes we want to be way down here. Maybe going into NVIDIA earnings, you might roll to a 25 delta option.
Right. Yeah.
And if everything's going well, you might want to just keep those deltas fairly high.
And for example, on this one that happened last night, and then the options, the stock today, had you done that, you were really happy you did that.
Oh, yeah.
Because the stock went down, but it's information that's now available to you today that it wasn't available to you tomorrow, and that's the management of the risk. And yeah, if it went the other way, would you have given up some gains? Yes,
Yep.
you would have.
So,
You wouldn't have had a higher delta, but you got to lose less if it went the other way. That's what a risk manager does. We're not profit managers. We're risk managers.
right. So if we look at the way that we're getting this red line to flatten out and to curve away instead of continuing heading southwest like this one in black, is that there's an embedded insurance policy. We know that the red line is really the combination of stock plus put. So there is, even though we don't see it in a call option, it's there. Mathematically, it's an insured position. And so what's causing this risk graph to flatten out, or to also not be as steep here at this point, is that insurance policy weighs on the deltas. You are paying for insurance. It's a benefit, all things equal, that this red line flattens out as the stock price falls, as opposed to continue hammering the losses.
Exactly. In other words, as the stock continues to go down, the deltas are going down. And
Right.
think about the price of the option, everyone. As the stock continues to go down, the price is heading towards zero.
Zero.
And it's not going any lower. And that's why the curvature is there and eventually flattens out at zero, because that's it. The game is over. It's done.
Yep. So now let's look at what happens as the stock moves higher and this option goes further in the money. So now, instead of looking down here around 100, let's look up here. Do you see how that black and red line are almost overlapping? And so if we look at the black line and the blue line is kind of representing the red one right there, you can see that you can't tell them apart.
It's very
And that's
close.
when that options delta is going to be 100 or at least very close.
Absolutely.
And
Yeah.
at this point, the insurance policy is worthless or pretty close to worthless.
Hmm.
And the way that we look at that visually, remember there's a bell curve over the current stock price. So let's say that the stock is at 115, that would be the center of the curve. And what we're saying is that mathematically, no matter how low this stock price goes, even all the way out here to this left tail, it just doesn't statistically have the ability to go to where this red line is going to start benefiting and curving away. And at that point, the insurance policy is worthless. You're trading shares of stock. Well, do we really want our deltas to get that high?
No.
Do we want them to get this low, or do we want to operate somewhere in here? And that's where the trick is with rolling. We don't do it just because of credits. Now, another thing to look at, where to see where the debits are coming from, let's compare two vertical spreads. Let's look at the 100-105 call spread, a debit spread, and the 100-105 put spread, the credit spread. So these are both bull spreads. Now, if we put these into a pricing model with 30 days to expiration, we get these two graphs. So this isn't accounting for price. We're saying that it's the payoff. So it's worth 0 down here at a stock price of 90, and it's worth 5 up here, the difference in strikes. Down here, it's worth 0. Here, it's worth -5. Remember, a credit spread's a liability.
Bill, can we go back 105? Okay, go ahead. Sorry.
So now the thing that I wanted to show is pick 2 points. Let's take a look out here at the far right. Notice that this lines up at 5. And if we put that into a pricing model, the level where that vertical spread, that call spread is worth 5, the put spread is worth 0. So notice that those two numbers add up to 5. If we go to this point where the blue line crosses 4, you could collect 4, or you would have to spend 1. We hit -1 down here, but 4, not counting the minus sign, 4 and 1 add up to 5. And if we come down here where the blue line crosses 2, at the stock price where that call spread is worth $2, the put spread is worth 3. So you can see that they always add up to 5. And that's part of the trick to understanding they're just two different sides of the same coin. All right, so now, how does this affect us? Well, before we do that, again, quick reminder, marketrebellion.com/get started, all kinds of great videos just like this one to help you get started with your trading careers. So let's go to an Excel spreadsheet and see where people make mistakes with this stuff. And to do that, I'm going to bring up the spreadsheet here. Okay, so now what we've got here, Stu, this is all done in a pricing model. We have stock prices going from 80 up to about 130.
Mhm.
We're looking at 3 different spreads. I have the 100-105 call spread,
Mhm.
the 105-110, and the 110-115. So we're just letting these roll through time. These are at different stock prices, assuming we're going to hold time constant. All of these have 30 days, which of course is not realistic, but it just makes it harder to create these graphs if you're always having to change time.
So what Bill's saying is at 80, the call spreads where the 100-105 call spread it has a theoretical value of 0. And at 90, it has a theoretical value of 31 cents. At 100, it has a theoretical value of probably about $1 and change.
Yep.
Dollar there you get $1.86. So
Yep. And that's what these lines are right here. So this is the 100-105 in blue. The red is the 105-110, and the green is 110-115. So we can see that the lower strikes, we know this from pricing principles, lower strike calls are worth more money. We know that the lower strike vertical spread has to have higher values across the board. It's also going to reach delta 1 sooner. It's going to reach its maximum gain sooner. So that's going to change our deltas. We can see that the slopes of these are quite different. So now here's the thing. Let's go do a little exercise here. I don't have the pricing on here, but I went into a pricing model, not a vertical spread, but just the $100. I'm sorry, the $90 call. 30 days to expiration is worth 1043. So it's got 10 points of intrinsic,
It's over.
43 cents of extrinsic.
Mhm.
So this might be like our standard stock replacement type of position.
Could be. Yeah.
So now watch what happens. We're holding our call and we come down here to a point when the 100-105 vertical spread is worth $4.
So what
Right?
happened?
We don't want to roll it up here. That's an expensive put.
The stock went up. You got to remember.
Stock went up. We
Stock
can now
is-
trade it for $4. The stock would have to get to 111.
Like the $2 spread doesn't get to be 4 just because, right? Something has to happen. What happened? This is simulating the stock moving higher.
Right. And it might get here sooner if time had gone by.
Maybe
But again, in this model here, we're just looking at the stock price moving.
depends on the
So
stock.
we could roll it. We could grab $4, 404 technically, but round terms, let's say you grab your $4 credit.
Mhm.
Now we come down here, stock price moves some more up to 116. Can we call that $4 too? I
Yes.
think we can call that $4. And we say, hey, it's trading at 4. I'm going to roll it again. I get another 399.
All right. Now you're up to $8. I got a nice $8 bill in my pocket. Go.
Yep. And then the stock goes up to 121.5 when the 110, 115 spread is trading for 4. And I have another $4 credit.
You sure you didn't model this after NVIDIA a couple weeks ago?
It's kind of what it felt like, didn't it? Going through the service every single day. We were getting a 410, 430 credits every single day.
So we got $12 so far that we've taken in.
So we've got $12. So now let's say we decide to close it here at a stock price of 125.
Okay.
Now we've got the 115 call.
So how much are they? They are $10 in the
They're
money.
$10.
Right.
Now again, whether we still have 30 days, they might be 10 and a few pennies if we're allowing time to go by. They're going to be trading close enough to parity. This is just to make it easier to follow. So they're $10. You cash in, you get $10. How much did you get from the rolls?
Well,
Not counting the little pennies there, we got $12.
mhm.
So we have $22.
Follow the money. 22
Follow
bucks.
the money. We have an 1157 gain from the 10 or that's over and above. That's the profit. So our percentage return, our ROI is 111%. Now, again, this is where traders look at this and they'll say, man, that rolling is magical. Look at all of the money I made from rolling. But they're not seeing the fact that they mathematically paid for the puts and that they really reduced their deltas on those incremental returns. There's a very big cost. And the way we can see it, let's go back to the 90 call who never rolled. And when the stock is 125, what's that call worth there, Stu?
35 bones.
$35, which is a gain of 24.57. And that is how much?
135.
135%, which is quite different from 111.
So which guy did better, everyone?
So again, you have to say the rolling is done for risk management purposes. It is not done for return enhancement, which is what everybody thinks.
Yeah. So,
That's-
super simply here, the guy that held on to the 90 or the trader that held on to the 90 call, that person made more money than the person that
Absolutely crushed it.
crushed it. I mean, he didn't.
Had higher deltas throughout, never had to pay those dollar for the rolls.
Yeah. He made more money. He didn't make, well, let's just leave it at that. He made more money.
No doubt.
The guy, the other side of that statement is the guy that rolled made less money, of course, right? If one guy makes more, the other guy makes less, right? We just put it in percentage terms. But the bottom line is for cash is cash, then one guy made more than the other guy. So does the other guy get to have bragging rates because he did better? So here's where here's where the art comes in, everyone. The guy that has the 90, would he really have stayed in it riding the 90 all the way up versus
He probably would have been way out here.
Maybe,
Yeah.
right? The guy that kept rolling it up and moved the strike price up and had that intrinsic value sitting in his bank somewhere, which is
Right.
his trading account. He's got the ability to sleep at night with the position that they have on and they could stay in it and continue to ride that 20 or 30 or 40 or 100 point run.
And split 10 times and he's still riding it. Right.
And he's still riding it, and he's still riding it. I had a client a few years ago. This is pre-split in Tesla, when the stock was like 150, who got into stock replacements, and the guy swore to me, he said, "This thing's going up. This thing's going up. I want to get in it, but I don't really want to buy the stock because it's too volatile." So, we did the stock replacement thing, and the stock. Everybody knows what happened to Tesla. It just started taking off, and we rolled them up and rolled them up and rolled them up, and the thing went to like, pre-split, I think it was about $22,000, if I recall correctly. I mean, it was insane what happened with that stock. And
The position, not 22,000.
what's that?
You said 22,000.
Oh, no, I meant like 2000. And he would, I mean, who's staying in it?
Right. Who would stay in it that long?
Who
Right.
would stay in it? I mean, you're not staying in it, but the rolling allowed him.
Keeps your insurance policy closer to the action.
Right. You felt okay. You weren't panicking. And that's a volatile stock, right? He wasn't panicking every time it had a hiccup and went down, because he had money that he was taking off the table along the path of the road. That's what the volatility is.
Right. Right. Now let's look at the other side of this, Stu. That we showed the perspective that the stock went up. Where could we make a strong argument that you would have been way better off by rolling? Now this would be an extreme example, but let's say the stock came up here to 125 and then reverts all the way back to here. How much does this guy have? Zero.
Nothing.
What does this guy have?
He's got all the roll money in his pocket.
He's got the roll money in his pocket. So they both lost, but one just lost less because he had an insurance policy.
Yeah.
So always remember, that's the purpose of the insurance policy. So as a final example, think that if you have, I don't know, the stock at 100 and you buy a 95 put. So you have an insurance policy 5 points out of the money. You might think, okay, it's only 5 points out. I've got pretty good insurance. But what happens as that stock goes to 110, 120, 200? The distance where that insurance policy kicks in, it's like having larger and larger deductibles. It's not such a hot deal anymore. But when you roll it, what are you doing? You're bringing those together. The stock moves up, you're bringing those together. That's why there's a cost. It's not free money, it's a cost. But if it's used in the right way at the right times, it can be an invaluable tool. And so that's really what we wanted to present to everybody here. So Stu, let's do our last. Where'd it go? Chalk talk. So what do y'all think? If you roll call options, will you enhance returns? What do you think, Stu? I know my answer.
Maybe.
I think I'm becoming too obvious. That's exactly what I said. It just depends. In a perfect world, if it's just screaming to the upside and you never rolled, no, you're not going to enhance returns. But that's rare. It's also rare that you're going to have nerves of steel to ride through that. Instead, if you start seeing volatility, but you're able to stay in it and keep that insurance policy close to the action, you will probably outperform, even though we could make an argument that you're not going to, because of this embedded put that you're buying and because you're squashing your deltas. But again, what we really want to show people is the importance of understanding your options, your strategies, your pricing theory, because if you don't, it's really difficult to make good, consistent decisions. So, Stu, any closing comments?
There's a lot of psychology going on here.
Yeah.
You can't really read about in the books about options theory and all that. It's a lot of it's game theory, in a way. It's the game that you're playing with yourself. It's trying to beat that,
Right.
psychological. Maybe you think it's an edge, maybe you think it's not an edge, but it's being able to sleep at night, stay in it for what's creating wealth. Buying them at 5 and selling them at 7 is going out to dinner, right? It's not creating anything. Really.
Yeah, there's right, exactly right.
It's not creating wealth. The wealth is going to come from being able to come up with a spider that's making 10% a year over 30 years. Every once in a while, you're going to hit an Amazon, you're going to hit a Google, you're going to hit an Nvidia. You're going to hit those stocks every now and then, and this this strategy allows you, from a risk management standpoint, to hang in there and help yourself to create these gains.
Yep. Well said. So, in conclusion, for all of you out there in YouTube land, if you are rolling, ask yourself, why are you rolling? Is it because you're going to outperform in terms of dollars compared to not rolling? No, you won't. Are you going to outperform in terms of dollars because you are able to stay in the position longer? Or because what if it goes against you, you've lost less? Then you can make a very strong case for rolling. But those are the questions you have to address to figure out when and how to roll, as opposed to I roll anytime I can get a credit because it's just free money. And with that, I think that's probably a good stopping point, Stu, but these are all great topics that we talk about each week, twice a week, Tuesday, Thursday, and Q&A. If you're interested in joining us, we'd love to have you. Please call marketrebellion.com and ask for one of the salespeople there. Would be happy to help you. And with that, Stu, more interesting trading for the rest of the week, and we'll have to check it out next Thursday, 4 p.m. for Coach's Corner, and we'll see you then.
All right.